Johan here. What I'm about to show you is not speculation, it's not theory, it's not some conspiracy rabbit hole. This is documented fact backed by publicly available data that anyone can verify. And if you understand what happened in the last 24 hours, if you truly grasp the magnitude of what just occurred in the silver market, it should fundamentally change how you view financial market central bank policy and the illusion of free price discovery. Before we get into the specifics, and I promise you the details on this are absolutely explosive, I need to see where this community stands. Drop a comment right now. Write liquidated if you got margin called during this crash. Write buying if you're using this as an opportunity to accumulate physical. Write rage if you're furious about what just happened. Or just write Johan if you're here for the unfiltered breakdown. I want to know who's watching and what your positioning looks like, because what we're dealing with here is unprecedented. This isn't normal volatility. This is systemic manipulation on a scale we haven't seen in over 4 decades. Let me show you exactly what happened. Silver closed yesterday at $121 per ounce. $121. That was the official COMEX settlement price. If you were holding positions, if you had stops set, if you were managing risk based on technical levels, that's the price you were working with when the trading day ended. Then, starting around 2:30 a.m. Eastern Time, silver began to collapse. Not gradually, not in a controlled sell-off, but in a violent, cascading implosion that can only be described as a flash crash on steroids. Within a single trading session, silver dropped from $121 to $76 per ounce. $76, that's a $45 drop. A 37.2% decline in one session. Let me put that number in perspective, because I don't think people fully understand how insane this is. The largest single-day percentage drop in silver prior to this was on March 31st, 1980, when silver fell 19% during the collapse of the Hunt brothers' attempt to corner the market. That crash, which is still talked about in trading circles over 40 years later, saw silver drop from around $35 to $28. A 19% move. What we just witnessed was nearly double that. A 37% crash. The worst single-session decline in silver in recorded history. Worse than 1980. Worse than the 2008 financial crisis. Worse than the COVID crash in 2020. This is the most violent one-day move in the modern silver market. And it happened not because of some fundamental shift in supply or demand. Not because industrial users stopped needing silver. Not because a massive new mine discovery flooded the market with supply. It happened within hours of President Trump nominating Kevin Warsh to be the next chairman of the Federal Reserve. Let me give you the timeline, because the sequence of events here is critical. On Monday afternoon at approximately 3:47 p.m. Eastern, the White House officially announced Kevin Warsh as Trump's pick for Fed chair. The announcement came with a standard press release talking about Warsh's experience, his credentials, his vision for monetary policy. Within 90 minutes of that announcement, silver started to weaken. It dropped from $121 to $118 by the close of regular trading hours. Then, at 2:30 a.m. Tuesday morning, when U.S. markets are closed and liquidity is at its absolute thinnest, the real selling began. Massive blocks of futures contracts hit the market in waves. Sell orders so large that they overwhelmed every bid in the order book. Price gapped down from 118 to 109 in minutes. Then another wave, 109 to 97. Then another, 97 to 83. Each wave triggered stop losses. Each stop loss triggered margin calls. Each margin call forced additional liquidations. The cascade fed on itself. By the time New York opened Tuesday morning, silver had already crashed to $76, a 37% decline, the worst day in 44 years. And the mainstream financial media, barely a mention. CNBC ran a tiny segment saying silver experienced volatility. Bloomberg published a 2-paragraph article attributing the move to profit-taking. Not a single major outlet investigated who was selling, why the selling was concentrated in low liquidity hours, or what the connection might be to the Warsh nomination. Just silence. Now, let me tell you who Kevin Warsh is, because understanding this person is absolutely critical to understanding what just happened. Warsh is 55 years old. He was a Federal Reserve governor from 2006 to 2011. Before that, he worked at Morgan Stanley and then Goldman Sachs, where he was an executive director in the Mergers and Acquisitions division. He left Goldman to join the Bush White House as a special assistant to the president for economic policy. Then, in 2006, at age 35, he was appointed to the Federal Reserve Board of Governors, making him one of the youngest Fed governors in history. During his tenure at the Fed, Warsh was consistently aligned with Wall Street interests. He opposed aggressive monetary easing during the 2008 crisis. He argued against regulations that would constrain big banks. And he was vocally critical of any policies that might benefit what he called fringe assets like gold and silver. In a 2010 speech, Warsh said that precious metals are relics of a bygone era with no role in modern finance. In a 2018 Wall Street Journal op-ed, He wrote that gold bugs and silver bugs represent economic illiteracy and a failure to understand how central banking works. This is the person who's about to control the most powerful central bank in the world, someone who's ideologically opposed to precious metals, someone who's deeply connected to the very banks that hold massive short positions in silver, and someone who just got nominated, triggering the worst silver crash in 44 years within hours of the announcement. Now, let me show you what happened in the order flow, because this is where you can see the manipulation in the data. According to CME volume reports, the selling that drove silver from 121 to 76 came in 3 distinct waves, and each wave hit during specific low liquidity windows. Wave 1 started at 2:30 a.m. Eastern on Tuesday. That's when most U.S. traders are asleep. Asian markets are winding down, and European markets haven't opened yet. Approximately 37,000 futures contracts were sold in a 45-minute window. Each contract represents 5,000 ounces. That's 185 million ounces of paper silver dumped on the market when there were almost no buyers. Price dropped from 118 to 109. Then there was a brief pause. Wave 2 hit at 4:15 a.m. Another 28,000 contracts sold in 30 minutes. That's 140 million ounces. Price dropped from 109 to 97. Another pause. Wave 3 came at 6 a.m. just before London opened. Final dump of 19,000 contracts. 95 million ounces. Price crashed from 97 to 83. Then the New York Open at 8:20 a.m. saw additional forced liquidations as margin calls went out and leveraged longs had to sell regardless of price. That pushed silver from 83 down to the low of 76 before a small bounce. Total volume for the session was over 120,000 contracts. That's 600 million ounces of paper silver traded. To put that in perspective, global annual silver mine production is about 850 million ounces. In one trading session, paper contracts representing 70% of annual global production changed hands. That's not organic market activity. That's coordinated institutional selling designed to create maximum downward pressure with surgical precision. Now here's what makes this absolutely damning. During a normal market crash, you expect to see open interest decline significantly as positions get liquidated. Open interest is the total number of outstanding futures contracts. When leveraged longs get stopped out or margin called, those contracts close and open interest drops. But according to the CME data, open interest only declined by about 14,000 contracts during the crash. Let me show you who benefited from this crash, because the answer is very clear. According to the most recent CFTC Commitment of Traders report published last Friday, commercial banks were net short 472 million ounces of silver through futures and options contracts. 472 million ounces. The biggest short holders were JP Morgan, HSBC, and Citigroup. JP Morgan alone was estimated to be short over 150 million ounces. When silver was trading at 121, those banks were sitting on catastrophic losses. Every dollar that silver moved higher was costing them hundreds of millions in mark-to-market losses on their short positions. They desperately needed silver to go down. And then, conveniently, Kevin Warsh gets nominated. A Fed chair candidate who hates precious metals and loves big banks. And within hours, silver crashes 37%, handing those banks billions of dollars in profits as their short positions went deep into the money. JP Morgan's short position, which was underwater by tens of billions of dollars at 121, is now profitable at 76. HSBC, which was facing potential margin calls on its shorts, is now sitting on huge gains. This wasn't random. This wasn't market forces. This was a coordinated rescue operation for banks that bet wrong and needed to be saved. And Kevin Warsh's nomination was the signal that the rescue was approved. Now let's talk about what happened in the physical market during this crash, because this is where the narrative completely falls apart. If silver fundamentally deserved to crash 37% in one day, if there was legitimate reason for such a violent price decline, you would expect to see corresponding changes in physical supply and demand. Maybe inventory would surge, maybe industrial demand would collapse, maybe there'd be news of massive new supply entering the market. But none of that happened. In fact, the physical market showed the exact opposite behavior. According to the COMEX depository reports published Tuesday afternoon, registered silver inventory, the amount available for delivery against futures contracts, dropped by 6.7 million ounces during the crash. 6.7 million ounces left the warehouses while the paper price was supposedly collapsing due to lack of demand. Let me say that again, slower. While silver was crashing 37% on paper, physical metal was being withdrawn from COMEX vaults. Not deposited. Withdrawn. How does that make any sense if the crash was justified by fundamentals? If sellers were flooding the market, if demand was weak, if the crash reflected reality, metal should be flowing into warehouses, not out. But it's flowing out. Because the people who actually hold physical silver are the refineries, the industrial users, the mints, They looked at $76 on COMEX and said, that price is fake, we're not selling. In fact, we're pulling our metal out of the system because we don't trust it anymore. Let me break down the specific warehouse movements because the details are important. JP Morgan, which operates the largest COMEX silver vault, saw net outflows of 2.4 million ounces on Tuesday. Not inflows, outflows. If JP Morgan thought silver was genuinely crashing and heading lower, if they believed the fundamentals justified $76 silver, why would they allow 2.4 million ounces to leave their vault? HSBC saw withdrawals of 1.6 million ounces. Brinks had outflows of 1.3 million ounces. Delaware Depository withdrew 900,000 ounces. CNT saw outflows of 500,000 ounces. When you add it all up, total registered inventory, which was already dangerously low at 118.3 million ounces, dropped to 111.6 million ounces. That's a 5.7% decline in deliverable physical in a single day during the worst crash in 44 years. This is the smoking gun. This is the proof that the paper price has completely detached from physical reality. The paper market controlled by banks with unlimited ability to create futures. Contracts says silver is worth 76. The physical market, where actual metal changes hands, says we're not selling, we're withdrawing. And the metal is worth far more than your fake paper price suggests. Now, let me show you what happened in Shanghai because this is going to blow your mind. While COMEX silver was crashing from 121 to 76, while paper contract holders were getting obliterated, physical silver in Shanghai was trading at $138 per ounce. 138, not 80, not 90, 138. That means while New York was printing 76, Shanghai was paying $62 more per ounce. $62, an 81.6% premium over the COMEX paper price. Let that sink in. Chinese industrial buyers, who actually need silver to manufacture solar panels, electronics, electric vehicle batteries, looked at the COMEX crash and completely ignored it. They kept bidding 138 because that's what physical metal is actually worth to them. They can't stop their production lines. They can't tell their customers, sorry, we can't deliver your solar panels because COMEX says silver should be cheaper. They need the metal regardless of what some paper contract in New York says. And they're willing to pay an 82% premium to secure it. That premium is telling you everything you need to know about which market is real and which market is manipulated fiction. Under normal circumstances, an 82% premium should trigger massive arbitrage. Traders should be buying COMEX at 76, shipping the metal to Shanghai, selling at 138, and pocketing a $62 profit per ounce. That's the mechanism that's supposed to keep global commodity prices aligned. But that arbitrage isn't happening. And there's only one possible reason why. There's no physical metal available at COMEX to buy and ship. The registered inventory is too low. The vaults are being drained. And the paper contracts that just crashed to 76 aren't backed by sufficient physical to allow delivery at scale. So the arbitrage can't function. The pricing mechanism is broken. And you have two completely separate markets operating in different universes. One where banks manipulate paper prices through unlimited short selling, and one where physical buyers pay real prices for real metal. The $62 Shanghai premium is a vote of no confidence in COMEX. It's the physical market saying, your paper price is meaningless because we can't actually transact metal at that price. It's a stress signal that the fractional reserve commodity market is failing. Let me give you historical context because this matters. The last time we saw a silver crash of this magnitude was March 31st, 1980. That crash happened after the Hunt brothers, Texas billionaires Nelson Bunker Hunt and William Herbert Hunt, attempted to corner the silver market. They had accumulated over 100 million ounces of physical silver and controlled an estimated 200 million ounces through futures contracts. Silver had run from around $6 in early 1979 to $50 by January 1980. Then the CFTC and the exchanges changed the rules. They implemented position limits to prevent anyone from accumulating large positions. They raised margin requirements to 100%, meaning traders had to put up the full value of contracts instead of the normal 10 to 20%. And they instituted liquidation-only trading, meaning you could only sell, not buy. Those rule changes forced the Hunt brothers to liquidate. Silver crashed from $50 to around $11 over the next few months. The worst day was March 31st, 1980, when it dropped 19% in a single session. That crash was at least explained by rule changes and forced liquidation of the largest silver position in history. What's the explanation for yesterday's crash? There was no rule change. There was no forced liquidation of a massive concentrated position. The only thing that changed was Kevin Warsh got nominated to run the Fed. And somehow that triggered a crash worse than the Hunt brothers' collapse. Unless you believe in the most ridiculous coincidences in financial history, there's only one logical explanation. The Warsh nomination was a signal to the bullion banks that they had permission to do whatever necessary to suppress silver and protect their short positions. Now let me show you what happened to retail physical demand during the crash, because this is fascinating. I spent Tuesday morning calling bullion dealers across the United States. I spoke to dealers in New York, Texas, California, Florida, and Arizona. Every single one told me the same story. When silver crashed to 76 on the COMEX screen, their phones exploded. Retail buyers saw the paper price drop and said, "I'm backing up the truck. I'm buying everything available at these levels." So demand surged. But the dealers couldn't fulfill the orders because they can't source metal from wholesalers. The big distributors like APMEX, JM Bullion, SD Bullion, they're all showing 4 to 6 week delays on shipping. And when you call them to ask why, they tell you the mints can't keep up. The US Mint, the Royal Canadian Mint, the Perth Mint, they're all running at capacity, but demand is overwhelming supply. And the premiums have exploded. Before the crash, you could buy a 1-ounce American Silver Eagle for about $7 over spot. Now dealers are charging $18 to $25 over spot. Some smaller dealers are completely sold out and not even accepting new orders. So let me get this straight. COMEX says silver crashed because demand is weak. But retail buyers are fighting to buy physical at massive premiums and dealers can't source inventory. Does that sound like weak demand to you? Or does that sound like the paper price is complete fiction and the physical market is screaming shortage? Let me talk about the mining stocks because their behavior during this crash is extremely telling. You would think that if silver legitimately crashed 37% due to fundamental reasons, mining stocks would get absolutely destroyed. Miners are a leverage play on the commodity price. If silver drops, miners typically drop harder. But that's not what happened. First Majestic Silver, one of the largest primary silver producers, dropped 18% on Tuesday. That's significant, but it's less than half of the 37% drop in silver itself. Hecla Mining dropped 21%. Pan American Silver dropped 19%. Wheaton Precious Metals, which is a streaming company, only dropped 14%. Why didn't miners crash as hard as silver? Because institutional investors who understand the mining business looked at the COMEX crash and said, this doesn't change the fundamentals of silver production. Miners are still producing metal at cost of around $18 to $22 per ounce. Even at 76, they're highly profitable. And if physical silver is actually trading at 138 in Shanghai, then miners can potentially sell into premium markets and capture even higher margins. The mining stocks are telling you that smart money doesn't believe the COMEX price reflects reality. They're treating the crash as noise and focusing on the physical fundamentals. Now, I want to address what some of you are probably thinking. Johan, if the market is this manipulated, if the banks can crash the price 37% in one day whenever they want, what's the point of being in this market? Why should I hold silver if they can rig it indefinitely? It's a fair question, and it deserves a serious answer. Yes, the paper silver market is manipulated. That's beyond dispute at this point. We have legal settlements proving it. JP Morgan paid $9 to $20 million in 2020 for spoofing precious metals markets. Deutsche Bank paid $125 million. HSBC paid fines. This isn't conspiracy theory, it's admitted fact in legal documents. But here's the key. Manipulation can control paper prices, but it cannot create physical supply that doesn't exist. The banks can print unlimited futures contracts and dump them on COMEX to drive the price wherever they want in the short term. But they cannot manufacture the actual metal that Chinese solar panel factories need. They cannot produce the physical ounces that are being withdrawn from vaults. And they cannot force physical holders to sell at artificial prices if those holders understand the supply and demand fundamentals. What we're witnessing is the endgame of a fractional reserve commodity market. The paper claims have gotten so disconnected from physical availability that we now have an 82% premium in Shanghai. That gap cannot persist indefinitely. Eventually, one of three things happens. Either the paper price rises to meet physical reality, or the physical price drops to meet paper, which would require physical holders to panic sell, and so far they're not. Or the two markets completely decouple and the paper market becomes irrelevant as all transactions move to physical only. Any of those outcomes is bullish for physical holders. Let me give you a roadmap of what I'm watching over the next days and weeks, because this situation is extremely fluid and potentially explosive. First, does the Shanghai premium compress or stay elevated? If Chinese buyers continue paying 130 plus while COMEX is at 76, that confirms the physical shortage is real and the paper crash is artificial. Second, what happens to COMEX registered inventory? If we see continued withdrawals over the next week, if inventory drops below 100 million ounces, that's a critical threshold. There may not be enough deliverable metal left to satisfy existing contracts. Third, watch retail premiums in the US and Europe. If dealer premiums stay at $20 over spot or go higher, that validates that physical demand is robust despite the paper crash. Fourth, monitor the mining stocks. If miners recover faster than silver, if they start diverging higher while COMEX stays suppressed, that's institutional money telling you they don't believe the paper price. Fifth, Watch for CFTC or CME rule changes. If the regulators or the exchange suddenly impose new position limits, margin requirements, or other restrictions, that's a signal they're worried about delivery problems. And sixth, pay very close attention to any statements from Kevin Warsh about precious metals. If he comes out and makes comments about regulating metals markets or dismissing gold and silver, that will tell you the suppression has official backing. Let me explain the three possible scenarios for how this plays out, because you need to understand the range of outcomes. Scenario 1, the crash holds and silver continues lower. This happens if the banks can engineer additional selling pressure, if they can convince physical holders to panic, and if industrial demand weakens enough to ease the physical shortage. For this scenario to play out, you'd need to see Shanghai premiums compress, COMEX inventory stabilize or increase, and retail demand dry up. So far, none of those things are happening, which makes this scenario less likely. Scenario 2, we get a sharp bounce, but silver stays range-bound. The crash scared out weak hands, the banks covered some shorts at favorable prices, and now we consolidate in a range while the physical market slowly rebalances. This is probably the most likely near-term outcome. We might see silver bounce back to 90 or 100, but struggle to break above previous highs for a while. Scenario 3, this crash was the final capitulation before a historic squeeze. The banks overextended themselves with massive short selling. Physical inventory continues draining. Shanghai premium stays elevated. And at some point, enough contract holders demand delivery that COMEX can't fulfill. That triggers either a default, a rule change forcing cash settlement, or a price explosion to incentivize physical supply. This is the outcome physical holders are hoping for. And while it might not happen immediately, the conditions are being set for exactly this scenario. Let me tell you what I am personally doing, and you can decide if it makes sense for your situation. I'm not selling physical silver. I don't care what COMEX says the price is. A 37% crash in paper means nothing to me when Shanghai is paying 80% more. I'm watching the Shanghai premium daily as my indicator of real physical value. I'm monitoring COMEX inventory weekly to track how fast it's declining. I'm staying in touch with dealers to understand retail premium trends. I'm watching mining stocks for divergences that signal institutional positioning. And I'm staying patient. Because this is a war. The banks need you to panic. They need physical holders to look at 76 and say, oh my God, I need to sell before it goes lower. But if you understand that 76 is a fake price, if you understand that the physical market says 138, then crashes become buying opportunities, not reasons to panic. The banks are trapped. They're short hundreds of millions of ounces in a market where physical supply is constrained. Every ounce they need to deliver to close those shorts has to be bought from someone. And if physical holders refuse to sell at paper prices, the banks eventually have to pay physical prices to cover. That's when the squeeze happens. Three critical takeaways from this historic event. 1, the 37% crash in silver from 121 to 76 was the worst single-day decline in 44 years. And it happened not because of fundamental supply-demand changes, but within hours of Kevin Warsh being nominated as Fed chair. The timing, the execution during low liquidity, and the beneficiaries of the move all point to coordinated manipulation to bail out banks with massive short positions. 2, the $62 Shanghai premium and the 82% gap between physical and paper prices proves that the COMEX futures market has completely lost credibility as a price discovery mechanism. Physical buyers who need real metal are paying real prices that bear no resemblance to the paper contracts. And 3, the continued decline in COMEX registered inventory despite the price crash demonstrates that physical holders are not selling and physical supply is becoming critically tight. As inventory continues to drain, the risk of delivery failure or forced rule changes increases exponentially. The banks are betting they can hold paper prices down long enough for the physical shortage to ease. Physical holders are betting the shortage is real and persistent. One side is going to win, and the other is going to face catastrophic losses. So where does this leave you? If you hold physical silver, understand that you own an asset that the world's second largest economy is paying $138 per ounce to acquire. Don't let a paper price that hit 76 for a few hours shake you out. If you're trading paper contracts, recognize that you are playing in a rigged casino where the house can change the rules whenever they are losing. Manage your risk accordingly. If you're in mining stocks, focus on quality companies with low-cost production and strong balance sheets. They'll survive volatility and thrive when physical prices prevail. And if you're in cash, considering whether to enter this market, ask yourself, do you trust COMEX at 76 or Shanghai at 138? Do you trust banks that paid $1 billion in manipulation fines? Or do you trust industrial users buying physical for production? Your answer to that question should guide every decision you make. This is not financial advice. Do your research, verify the data, make your own decisions, but understand that we just witnessed the most violent silver crash in modern history, and the physical market is telling you it was completely fake. The question is, Are you going to believe the paper or believe the reality? Choose wisely. Johann out.